Let's welcome in our next guest. Rahul Veera is with us, Fund Manager, Equity Investments at Nippon India, AIF. Rahul, good afternoon. Good to have you with us here. Before I come to you, I just want to quickly, once again, put out that table which we've been sort of discussing. This is sector-wise implications. We'll talk about the broader market, but let's maybe just focus our minds a little bit in terms of individual sectors where this impact may show up. And that is the table that we've been highlighting. Chemicals and pharma is a high tariff differential sector. Textiles and clothing is very large. And agri and meat products is another one which is extremely, the differential is very large. So, that's where there is, vulnerability is a little higher in that sense. Rahul, so let's just start with the tariff bit, right? Now, broader market, etc., we'll talk. But I think you do at the margin, like chemicals as a space, you see some opportunity there. What is your sense? That table just showed large tariff differential between what US charges, what we charge as a sector. And a lot of the chemical business is value addition at the end of the day, right? We don't make everything, it's not completely backward integrated. So we buy from somewhere, add value, and then sell, export, etc. Is it a space which gets hurt if tariffs are changed substantially? What is your sense?
See, overall, the specialty chemical market, right, globally is close to $700 billion. India is doing close to $35 billion of exports as of now. So even if 5% change happens, right, from a global supply chain perspective, there's an incremental opportunity for India. So from a perspective that China will also face some tariffs, which is one of the largest exporters, we would have an indirect second order benefit for India from a volume share plus market share gain. So from $35 billion, we can probably move to close to $50 to $60 billion. So a very large opportunity for chemical manufacturers, which will be offset by volumes given the tariff structure that will come possibly on the Indian manufacturers.
Right. No, you're saying if tariffs on India are raised to say 10-11%, it is positive for Indian exports.
So it will be benefited directly by China volumes as well. So the tariffs will also be applied to Chinese manufacturers.
Correct.
Yeah. So the differential between Indian tariffs versus the Chinese tariffs, there is still a large differential there. So the volume growth for Indian manufacturers will be relatively better off.
Got it. The only thing is that the cost of production in China is already low. Scale is much larger. They're much more backward integrated. And China, lots of industries receive state support. They may decide to do that, which is not the case here. So there are lots of variables, right? I mean, is it as straightforward?
No. So specialty chemicals wise, right, India is relatively better off. So whenever there is a chemistry, right, between volumes and value added, volume China is relatively better. Whenever there's a value add manufacturing process is concerned, Indian manufacturers are relatively better off. So whenever there is a little bit complex chemistry, right, Indians are relatively better off if you see all the competitive chains.
And which names specifically, Rahul, if you want to sort of just highlight a few names here in the specialty space?
Some of the fluorochemical manufacturers, right, where there is a consistent contract manufacturing opportunity is consistently increasing there.
Okay. And pharma also is another area which you like. Again, we don't know if tariffs will go up or not, but irrespective of it, you think it's a good. And US generics, yeah?
Yeah. So US generics export from India to US is close to $10 billion. Almost 40 to 45% of RX that is given in US, right? If the manufacturers are from the Indian manufacturers. We believe going forward, right, if there is a tariff increase, some of the molecules will be taken off by these large manufacturers given the low ROE kind of a business, but that will eventually be good for some of the other manufacturing companies who are doing large scale manufacturing of that particular molecule. So some of them will close down the exports to US, the other ones will start exporting all the more. So it will become more of a volume game. Whoever is large in particular molecule will do relatively much better now. Plus the pricing impact because of the lower competitive intensity that they will get.
Okay, hi Rahul, good afternoon and good to see you again. Well, let's keep the tariffs out of the way for the time being. Let's focus on the domestic stories. I believe you like cement. What do you like from there? It appears that pricing hopefully has seen a bit of a bottoming out. Volumes, I understand, have picked up as well. But how do you play this theme? Because you have two large conglomerates in there. that are fighting for market share. And because of that, we're seeing a push through of volumes. So give us your preference in that space.
Right. So top four cement manufacturers, right, are almost having like 65 to 75% of the regular capacity-wise volume share. Now, going forward, what will happen is a consolidation that had to happen from the mid-cap and the small-cap space. Largely 70% of the possible acquirers are done. Going forward, a few names might be acquired going forward. So this consolidation over the next 3 years seems to be very positive. Also, last year, given the low base of volume, right, 4 to 5% of volume growth that we saw last year, we believe the government capex will help push the cement volumes, plus the pricing impact will play out. So from a 1 year perspective, definitely the base impact will come into play. But from a 3 year perspective, the consolidation will help the industry overall.
Rahul, hi, afternoon. What else do you like? So if you're not too worried about India, the tariff threat and the impact that it will have on India, what are you doing with respect to your portfolio?
So we are very bullish on power sector. Right. So if you see the budget, right, the government allocation within the capital outlay of 11 lakh crore that they had given. So all the other subsectors other than the power, whether it was rail, roads or defense, had kind of a flattish outlay. Only power sector saw 14% of an incremental outlay YY basis. So we believe power sector is one of the themes that we need to consider from a long-term perspective. Also, if you see the overall policy for the government, right, there is a 9 lakh crore kind of an outlay over the next 10 years for the overall power distribution segment, out of which 3 lakh crore has already been tendered out. The other 6 lakh crore is expected to come over the next few years. Now, within this, we expect not the direct power generators, but transmissions, EPC players. There is enough opportunity over the next few years to generate decent alpha in the portfolio.
I was speaking to one of those players in the morning today, KC International. They completely, their outlook on the business concurs with your view that there's a lot of activity in the T&D segment going on, and they're beneficiaries of that, among other companies. Got that point. Rahul, let's talk about some of your other, preferred areas in the market. I think you like banks. You also like pharma. On banks, there's a big debate raging. There's this whole talk about whether credit growth will not pick up to the extent that one would have liked, whether it'll still be 10-11% credit growth this year. The other part of that debate is whether the best of the NIM phase for Indian banks is over, because you're just not getting low-cost deposits anymore. So then what will be the play here? I mean, what is it that will make bank stocks outperform the market?
Right. So see, if you consider NSE 500, right, the total profitability pool was close to 15 lakh crore last year, out of which 6 lakh crore, almost close to 40% the profitability pool comes from the banking sector. Now, for the past 5 years, even though the EPS compounding CAGR from 2019 to 2024 for the banking sector was close to 12 to 15%, but given the X of bank, NSE 500 companies were growing at 25%. So technically, the banking sector never got re-rated in the past 5 years. So going forward, again, X of banks, NSE 500 will be close to 10 to 12% kind of a PAT growth, but the banking growth will continue at 12 to 15%. So slightly better off than the lot of small cap, mid cap names, they will be continuing to do better. Hence, we believe that there will be considerable shift, even though the ROEs or the ROIs of the names are largely behind, but the valuation comfort is something that we are looking forward to. Now, on the credit growth, although the 10 to 11% expectation is pending for most of the street players, but we believe ideally 10.5 or to 9.5 will be the place where credit growth will take place. So a lot of the funding, right, recently on the credit growth side was directly done by the capital market itself. A lot of equity funding, QIPs prep over the last few years we saw. So that is kind of a slightly marginal impact on the credit growth that we saw in the industry. Then that will continue going forward.
Rahul, what about technology? Earnings is expected to be weak. FY26 is going to be a very subdued year in terms of growth, perhaps no better than what we had in FY25. Earnings estimates have been brought down, but stocks have also corrected and valuations have derated. So now how is the risk reward for tech?
The downside overall for the IT sector will be limited from here. So from the large cap perspective, 3 to 5% of the broader CC growth that is expected by the street. And for the mid cap names, 10 to 15% is the broader range. But the corrections across the large cap, mid caps has already taken place. 5-year average Ps are back to where they are. We believe downside will be limited, but at the same time, even upside is going to be very limited. We are overall underweight on the sector as of now.
Underweight on tech, no upside, no downside also. That's the view coming in. Rahul, thank you very much for joining in. We'll get into a break on the